With massive layoffs in nearly every sector, weakness in manufacturing, car sales, and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show with my guest today that says we are facing one of the most historic credit crises in history. Joining me today is Bert Dohmen. He is the founder of Dohmen Capital Research and also of the Wellington Letter. Bert, it's always nice being with you. Welcome back.
Yes, thank you very much, Daniel. It's always a great pleasure to be with you. Reminds me of the first time we met when you were at another firm and you were a star over there. And I met you in person and we had an interview. That was very nice. Yeah.
That's right. I believe it was Freedom Fest in Las Vegas.
That's right. You've changed your last name since that time.
Well, hyphenated name and a few kids in the mix. But one thing's for sure, our friendship has remained. Yeah. So that said, I read with great interest the latest installment of your letter, the Wellington Letter, where you speak about this historic credit crisis that we're facing. You also say that it's much worse than what we're hearing. Tell us about what you think is going on here, Bert.
Well, first of all, the long term. We look at the long term, the very long term cycles in the markets, and then we narrow that down to the short term using advanced technical analysis. Technical analysis basically measures a change in money flow into or out of the market. And that is key. Looking at earnings and dividends tells you what happened a year or 2 years or 3 years ago. It's like driving a car looking only in the rearview mirror. So we want to know what are the big people, what is the smart money doing now? And we find that out in real time, like today. What is the smart money doing today? This is how close it is. That's why we have caught major tops of bull markets, sometimes within 1 or 3 days. Which you can only do with technical analysis.
Okay, so how should we be protecting ourselves then?
Well, the first thing you want to do is protect what you have, And this credit crisis, we have to find out why. I always give reasons why. On TV, you don't hear that from analysts. They just say, this is going to happen, but they never give you a reason why, I give a reason why. Right now, for example, with the banking failures, the SVB, we have 3 of the biggest banking failures in U.S. history within 6 days, and everybody's pretending, this is a one-off event, that won't happen again. No, this is the tip of the iceberg. And if you know about icebergs, 1/7 of the iceberg is above water. That means 6/7 of the iceberg is below water, and that's going to sink everybody else.
Bert, you write about the systemic risks in the banking sector and how it will be felt for years to come. But what is an everyday person to do? Is our money not safe in the banks?
Well, yeah, let me just take this further, how bad it could be. Not only did we have these bank failures in the U.S., was followed by the biggest bank failure in Switzerland ever. The biggest bank, Credit Suisse, 137 years old, went bankrupt overnight, had to be bailed out. The company is bankrupt, but then UBS was basically forced to buy up the pieces, So This is now international. This crisis is not confined to the U.S. This is going to be an international crisis. What people are never told is that there is about $1.6 quadrillion of derivatives outstanding internationally. That is such a staggering amount. No one can really imagine how big that number is. And it's totally unregulated. There was a regulator, head of the CFTC in 1999. She tried to get derivatives regulated. And she was fought by the biggest names that you can imagine in the investment field because it would have stopped that whole game of playing with derivatives. And then she basically was forced to resign. But because she wanted to regulate this market. Now nobody really knows exactly how much it is. The best guess is 1.6 quadrillion. It could be $2 quadrillion of derivatives. When they start falling apart, it's going to be like dominoes. You know?
So did you take your personal wealth, did you remove it from the banks?
Oh, well, I did it beforehand. We've been advising people to put their safe money into things that will withstand the crisis that we are going into. You know, in beginning of 2020, so that's 3 years ago now, we said this decade is going to be like the 1930s, you know, because the cycle called for that. So that means 10-year depression. Okay, but I said it will probably be much worse than the Great Depression. And it all depends on what the government and the Federal Reserve does. Okay, we now see that we're doing the same thing as the 1930s, where it was a 10-year depression. It could have been a 2 or 3 year recession, but the policies of Washington really made it a Great Depression. We're going to see that again. We see it right now. Spending up the gazoo, tax increases like you cannot believe. They're going to double the capital gains rate, doubling the capital gains tax from 20% to about 40%. This is the killer for the economy. You know? I mean, it's investors that make the economy. They create businesses, and businesses create jobs. If nobody's creating businesses, you have no job creation. Then everything is done with giveaway money. And we saw what that caused.
So do you think we're going to see an exodus of Americans leaving the U.S.?
No, this problem, there's no safe haven. Usually, you know, I remember being on panels in 1979, 1980, when Jimmy Carter was president, and one topic was always to be discussed, what is a good country to move to? And I always said, don't move, stay here and fight. This is our country, you know? And so now there's no place to go. And look at that time, the safe havens were considered Australia and New Zealand and Hong Kong. And they are now the worst, you know? So there's no safe haven right now.
Switching gears here, Bert, we're speaking ahead of the Fed May meeting where most are anticipating and expecting a 25 basis point hike and then a pause from the Fed. How do you see it? What's your take?
I don't care if it's a 25 point hike or not. The fact is that the economy is standing still. There was just an article, a real estate developer, he had a high-rise building all ready to go, 30 stories, etc. He had the financing. Financing was pulled. They said he contacted over 100 banks to get replacement financing. He couldn't get over 100 banks to give him the financing. There is no lending going on. This is the first time in my lifetime that I've ever seen that, when nobody, no matter how trustworthy and how creditworthy, can get a bank loan. The economy is going to come to a standstill, and worse, because then everything starts imploding. You know, we saw an explosion with zero interest, or basically zero interest rates over the last 10 years. Now we're going to see the opposite. It's going to be an implosion.
And what is your sense about where the S&P and NASDAQ are headed? Which direction?
Well, I think we've got another, you know, usually severe bear markets have at least one index going for an 80% loss. Okay, we've had that before in other, you don't have to go back to the Depression, just go back, over the last several decades. So an 80% loss, and it'll probably be the NASDAQ. So you measure 80% down from the top where it was, and that's where the bottom might be, okay? And if things get really severe, then it might be much lower than that. But an 80% decline in the market is very possible.
What is your stand when we're talking de-dollarization? Is it happening now or just the fairy tale?
Very good topic. Very important right now, I think. We're seeing signs that the US dollar is going to have a major down move. And now, you always have to see, okay, what would argue for a down move versus an up move? The down move is that the economy in the US and other places is going to come to a standstill. That means that at some point there's going to be a massive new money creation. And the central bank in the U.S., which is the Federal Reserve, will probably have the greatest creation of artificial money that they've ever done in order to prevent a depression or try to prevent a depression. So that means that dollars will be shunned. And we see this now in the headlines, and everybody's trying to get out of the U.S. dollar and so on. And so that tells you what the agenda is. The agenda is now to have a weaker dollar, you know? And so we have been in favor of the U.S. dollar until about 2 months ago. But I think the big change has come in the U.S. dollar. Now, that has tremendous implications for the markets.
But when you say agenda, doesn't it reflect poorly forward-facing to the world in regards to the strength of the U.S. dollar? I mean, who cares about debt at this point? It's so out of control anyways.
Well, by having a weaker U.S. dollar, it's easier to shrink that mountain of debt that we have, you know, and it creates inflation pressures because a collapse of the economy is deflationary. So they're going to have some forces that offset the deflationary impact of the recession depression.
And when it comes to central bank digital currencies, Bert, is this an issue or topic that keeps you up at night?
Well, I'm waiting for my final projection to come true. I've been writing for the last 3 years. Digital currencies will all of the cryptos, which are about over 2,000, will end up at the same price eventually, and that is zero. They have no intrinsic value. The governmental policy will be to get them out of business because they want to introduce the central government digital currency. And that will be our money in the future. It's a great danger to our freedom, but it seems like nobody cares about freedom anymore. So you just have to do what you can. We're going to have a digital currency, and that means that every dollar that you have will be at the mercy of Washington. If you are a critic of Washington, of course, they can flip the switch, and then you can join the homeless people on the sidewalk.
So you've laid out the landscape for us. With everything said, Bert, where are the best sectors for investors to be right now?
Well, Danielle, in 46 years, we have made big money in every bear market. There are many techniques that we recommend, things to buy. For people who want to be perfectly safe, use U.S. Treasury bills, not use U.S. government instruments, but T-bills. T-bills, these are short-term, 1 to 3 months. That's the way to have total safety. Get it out of the banks if you want to, but even banks can buy that.
How about your thoughts on gold?
Yeah, our view is that it's going to go in several phases. The first phase that we're in right now is on the way to a top, an important top, and then a very, very strong correction in gold. So don't be trapped when you read headlines, gold made a new record high, okay? That would be a sell signal instead of a buy signal. Then you're going to have a big drop, and eventually you're going to have a great buying opportunity when the central banks step on the accelerator and create trillions and trillions of dollars of artificial money.
When you say a sell-off, how much are we talking here?
That's never easy to say. It's guesswork. We don't guess. We look at charts and see how far down could it go. A 10% would be minimum decline. You could even see a 25% correction in gold.
All right, Bert, thanks so much.
Okay, it's always a pleasure to be with you.
And thank you for watching. We'll have more great content headed your way, so be sure to stay tuned to the Daniela Cambone Show and sign up at danielacambone.com to stay on top of it all. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.